Okay, so if we look at this paper, 4 questions. I don't know what they say about what the final paper will be. They seem to be going more towards having 2 big questions, isn't it? Mixed ones. But I don't know, I haven't had a good look to see what they say. But this was the October paper of last year, 4 questions, 4 big ones. WACC, then investment decision, then analysis, ratios, and then lastly a question on mergers and a bit of treasury. I think it was forex or dividends, something like that. Okay, let's have a look. Question 1. If we look, it tells us about a company. Then this company, they give us different debt to equity and different costs of capital. They tell us about the CFO. He'd heard about something about Milan Modigliani, and he has the required. So 4 requireds. You required number 1, calculate the effective after-tax WACC and the total market value of capital employed for each of the possible capital scenarios. Recommend to management what the optimal structure is in terms of your calculation. So if I look at that, we're looking at optimal debt to equity ratio. There was a question in the assignment where we had a similar thing where we had to look at scenarios. Do you remember? And basically, what we're going to have is we're going to have different scenarios where at different levels of debt to equity, so say it's 20 debt, 80 equity, all the way to the opposite, let's say, 80 debt, 20 equity, and there's different scenarios in between here. The cost of equity changes. Usually cost of equity, as your debt levels increase, cost of equity goes up. And as your debt levels increase, cost of debt also goes up because more debt equals more risk, isn't it? So as our balance of debt to equity changes, so then the different cost of equity and cost of debt apply. And then once we have those, we calculate a WACC. So how do we calculate a WACC? We use this cost of equity and this weighting. And then we use this cost of debt and this weighting. Remember that here we've got to work with after tax because our WACC is an after tax number. And then we'll have different WACC numbers. And then we find the lowest. Maybe it's there. Lowest WACC equals optimal debt to equity ratio. So the question asks you to do this scenarios to identify the lowest WACC. It also asks you not only to do WACC, it also asks you to do the rands of equity, debt, and total capital at the different levels, or at that level. Let me just read it again carefully. Calculate the effective after-tax WACC and the total market value of capital employed for each of the possible structures. Okay. And they also want the total market value. Rand market value. Okay, so that's what this required is. It's 13 marks. So that's the bulk of this question. Then if we look at the other required, calculate the new investment and advise management how it should be financed. Do you remember, this is even something we did at second year level. We've got market value, this was also in the assignment, market value of current, so rather let's just say, we've got current state, then we've got the new investment, and then we've got new capital structure. Okay, so what they want is they want to know how this new investment will be financed. So current state will be equity and debt, and we'll have a total. Then the new investment, we know what that is. That has a total. And then we have a new capital, which is a total. Then we're going to apply optimal debt to equity here. So we're going to go like that. And then once we have that, we're going to balance back to here. And then we're going to recommend How the new investment should be financed, isn't it? That's what they're asking. So for 7 marks, and you can see often the issue is not that you don't know how to do the calcs, but that you don't understand it from the question, isn't it? So this question, the second one, B, says calculate the new investment and advise how it should be financed. Then C is a bit of theory, and D is a bit of theory. C, indicate, based on the assumptions that there are no taxes, there's no cost of financial distress, there's no agency cost, why the market value of the company is not affected by the capital structure of the company, right? When there are no taxes, no agency costs, no financial distress, it's a perfect market. Hey, it's Miller and Magliani. So Miller and Magliani argued that it doesn't matter if you have debt or equity, isn't it, or how much debt. So they're just asking you for 2 marks to indicate why that's the case. And then for D, they ask you to discuss the 3 of the Miller and Magliani assumptions that aren't mentioned above. And one of the, see if you can think of any that come to mind, or you can look in your notes. But they've given you 3. They've given you no taxes, no cost of financial distress, and no agency costs. So there were a couple more that I had given you. We're looking in a perfect market, hey? So that is one, actually, that the market is perfect. There's a couple, so you would have had to try and come up with 3 there. Question 1 for 25 marks. Looks very doable, or not? Going to see. Okay. Give it a try. The information is here. It's just 1 page of information. So they start off by telling you that Muscle Farm was founded to do diet supplements. Their current debt to equity is 2080. Okay, so this is current structure, 2080. Management is considering investing in a new product line, Busy Diet, that do beverages and health bars, and they're considering 5 capital structures for this new investment. The tax rate is 28%. They will generate steady earnings before interest and tax of 13.125 million. The pre-tax cost of debt will remain constant irrespective of the capital structure. It's pre-tax. So they're saying the cost of debt's not going to change no matter what your structure does. But this is what they're saying will happen. As your debt to total capital changes, so this is 20% debt of total capital, 0% debt of total capital. As your debt to total capital changes, so your cost of equity, you can see, climbs. We start off with, when we have no debt, our shareholders want a return of 18%, but when we have 50% debt, they want 26% return. 50% of the total. The cost of the investment is 25 million rand, and it will be financed through equity and debt using the optimal capital structure. So that's the new investment, 25 million. The current share price is 44 rand a share. There are 1 million shares. So from that, you can work out market value. Do you agree? You can work out market value of equity. And then they said equity, current debt to equity is 2080. So you can balance back to debt, isn't it? And then as the debt to equity changes, so that will change. Let me see what else they say. The CEO has heard of something called Miller and Magliani during a training session. He wants to understand it better. According to his understanding, there's no optimal capital structure, because the advantage of debt is counteracted by the increasing cost of equity. So WACC will always be the same. The theory is based on a number of assumptions. He's asked you to explain them to him. So that's for the theory part. Okay, so if we look, these are the 2 formats that you're looking at for the first 2 parts of the question, which is 20 marks. Let me dual page it. Come on. Okay, they don't look great, but there they are. So on this side, you're going to do the different scenarios. You're going to work out total WACC, and you're going to work out market value, total market value, and identify the lowest. On this side, you're going to do current state, add the new investment, get the new capital structure, and using the optimal debt to equity, which you're going to get from here, you're going to back it up. A quarter of your paper. I think a very fair WACC question for a quarter of your paper. You get the number of... Okay. For what? I'm confused. Yeah. Yeah. We're trying to work out the optimal debt to equity where WACC is the lowest. So we're doing... Yeah. Mm. Mm. Yes, it's in words. It's here. So here is 44 rand a share, 1 million shares. Okay, and there's the 25 million. This is the... Okay, yeah, so this is the shares, a million shares, 44 rand. They say to you, currently, the debt to equity is 2080, so that means that that's 80, therefore 20 is 11. So that's how I got to this. Current is 80-20, 60-40, yeah. There's the 25. Yeah, so 55 plus 25 is what gives me the 80. So it's like this. That, like that. Okay, it's fine. Yeah, whack is always a quarter of your, I would say, 25%. That's it. 7 marks, the easiest 7 marks you've ever seen. Do you agree? So my current debt to equity is 80-20. I've got 55 million of capital. I need another 25. I'll have 80. Using the 60-40 split, which I'd said was optimal, I need 48-32, so I'm going to need 4 and 21.
So the trick here is making sure that first we know that it was pre-tax.
Yes.
So we get our cost of debt percentages right.
Yes.
And then we just plug in all those figures if we have the right formats. We figure out the optimum debt to equity. And then and then that 55 million for
Yeah, you had to remember. Yeah.
So
There was just one piece of information that I didn't use and I wasn't sure. They gave us EBIT. And then afterwards I didn't know what must I use EBIT for. I don't know.
They wanted to confuse us.
Yeah. They sometimes use a question that they had from something else with a different required and they just put the same information and change the required. Then sometimes you have, but I didn't find a way to use EBIT. I didn't know what I was supposed to use EBIT for. We would have used earnings if we had a PE ratio or something like that, but we didn't really have one. And
No, don't confuse us. That's fine.
Yeah. Yeah. So you were looking for the optimal WACC, which is where it's the lowest. We're looking at a capital structure decision. Well, how much debt, how much equity in my business, yeah. And so I was looking for the optimal WACC. I was told that the cost of debt doesn't change. So no matter how much debt you have, the bank will lend you at the same amount, at the same rate. But that our shareholders, if we take on more debt, their cost of equity changes. So we had to use the different scenarios to work out where it's the lowest. It works out to be the lowest at 60-40, 60% equity, 40% debt. And then the values, we had to just work backwards from the share price and the current debt to equity ratio. Then, and then for part B, we have this new investment of 25 million. We need to decide how to fund it. So we know it will be mostly debt because we're sitting at 2080. We need to go to 4060, but we need to know exactly how much. And then when we work it out, that's how much. So then the next point in the decision, in the decision making, is then to say, okay, I've got this investment. It's 25 million. 4 million through equity. 4 million is maybe a small amount of equity. It's Less than 10%, do you agree? So maybe that I can finance through retained earnings, perhaps. I don't need to do a new share issue, or maybe a rights, or maybe do a scrip dividend instead of giving dividends, offer shareholders shares instead of dividends to keep some money back. Yeah. And then on the 21 million, the debt, I then am looking for debt that is similar in maturity to the investment. So if my investment is very long term, I'm looking at very long term. If my investment is shorter term, I'm looking at shorter term. And then I look at different options there. What are my options and which one to choose? So it wasn't that bad. I didn't think it was that bad. You guys were okay as well? Okay. Then the last 5 marks, Miller and Modigliani. Let's just have a look at what Miller and Modigliani say quickly. Miller and Modigliani say it doesn't matter if we have more debt or not. Okay? But what we can see from here is that more debt actually does increase the cost of equity, isn't it? So I say debt increases, it results in an increase in risk and an increase in cost of equity. When cost of equity goes up, the share price will drop, isn't it? Because it all matches. Yeah? Cost of equity goes up, and if your dividends stay the same, share price drops. Yeah? Or because, look, there's the formula that uses cost of equity to get value. Dividend 1, R minus G. Yeah? There's cost of equity. Yeah? There's share price. So if this goes up, I'm dividing by a bigger number. This will come down, isn't it? That's what's going to happen. But the other side of the coin is that as I get more debt, this number will go up, isn't it? Because I'm borrowing money, investing it, getting a return. So this number goes up, and this goes back up, and then this evens out. That's what Miller and Modigliani say. Okay, so basically that's what I said there. Debt increases, it results in an increase in risk, cost of equity goes up, share price will drop. But the increased capital in the form of debt will increase profit, increase dividends, and therefore the share price will go back up, because that number goes up, dividends go up, growth goes up, and so therefore then because of this dividend model, then the share price goes back up and stays the same. Okay, that was worth 3 marks. Then there's other assumptions. No transaction costs, markets are perfect. Remember I spoke to you about this. All shareholders, all investors have the same information, and they all act rationally, isn't it? Nobody's making decisions based on emotions or what they like. It's just all based on rational, informed decision making in a perfect market with no transaction costs, and that's the Miller and Modigliani. So here they just asked for two more assumptions. Hey, was that what you had to come up with, or was it 3 more? It was something like that. 1 was 2, 1 was 3. But I think you could have come up with hopefully something here, even if you just get a couple of marks down here. And then there, I didn't think it was too bad. Yeah? All right. Second question. Is your favorite? It's my favorite. Let me say it's my favorite. It's a CapEx question. They say to you, using NPV calculation, determine whether SANRAL should invest in any of the above to recover the costs of infrastructure. Round off your workings to the nearest rand. It's 22 marks. It's that NPV calc. Okay. It's a bit of an upside down NPV calc. Because what it is SANRAL, you're familiar with SANRAL, right? SANRAL needs to recover, where's the amount of money they need to recover? 17, almost 18 million rand that they've spent on the cost of roads. And they're looking at 2 possibilities to recover that money. The one is e-tolls, and the other one is to increase the fuel levy. So it's the same principles that you would use in an NPV calc, right? But these are the 2 scenarios. So these are the 2 you've got. You're going to do 2 NPV calcs. Let me see. They tell you what the life is of it. They say they're hoping to recover the money over a period of 5 years. Okay, so this is what your picture should look like. You should have e-toll on one side, and you should have levy on the other, increased levy on the other. And then you're going to have from year 0 all the way to year 5 for both of them, right? Year 0 all the way to year 5. Then you're going to start off in each one with trying to recover the roads cost, which is 18 million. Do you agree? That's what I'm trying to recover in each case, is I'm trying to recover the 18 million. So then I'm going to go through the question, and as I read through it, I'm going to identify the cash flows. Because it's such a different question, we're not going to find sales and materials and labor. We're not going to find that stuff. Do you agree? Which is the stuff we usually find. But we will find cash flows, and you're just going to put them in as you find them. So the very first piece of the question starts to give you cash flow. So they say, if we do the ETOL, we will have gantries. You see those? It's those blue lights in the night, yeah. With the blue lights. We've blinged up our roads. Yeah. Then we also have IT systems for the toll roads. And we have to put in a control center, which will be in Paarl. And a customer center for people that phone in to complain that they weren't ever in that place, in that road, and they've been billed. For the fuel levy, it's just an extra IT system that you need to put in to account for that fuel levy. They say to you, and then they give you the story. They say, SANRAL expects 2.3 million cars to drive through the gantries in a year at an average toll fee of R3.60 per car. About 30% of the cars won't register for e-toll, and it will be impossible to recover that money, bad debt. The total revenue is expected to grow in line with the number of cars. A bit later, they tell you how the number of cars will grow. The e-toll company, TCC, has been provisionally awarded 6.5 million rand on tender to manage collection of toll fees. We're going to pay someone to collect that revenue. The fee will be paid annually in arrears, in equal installments over the next 5 years. Okay. Working capital of 1677123 is required at the beginning of the project. So you can see cash flows. They're not identical to a cash flow if it was a machine that we were buying, isn't it? But they're not undoable. And then there's the fuel levy. SANRAL will charge a fixed fuel levy of 55 cents per litre for the next 5 years. South African road users are expected to use 35 million litres of fuel in the first year, of which the Western Cape will consume 30% for the duration of the project. Annual consumption of fuel will increase in line with road users. SANRAL has estimated initial working capital to be 234,187 and operating costs of 650 per annum. The National Association of Automobile Manufacturers expects the Western Cape road users to increase at 6% per annum for the duration of the project. SANRAL is exempt from paying tax, and so there's no tax rate. WACC, so there's no tax in our numbers, so you should all be going, yay! And then WACC, the WACC is the RSA government bond. It's the risk-free rate. We're dealing with government, isn't it? So WACC for them is... No, nothing. The WACC is calculating using RSA government bond rate of 7% before tax. But remember, our cash flows, are they before or after tax? Before tax, isn't it? We're not going to put tax in our cash flows. So we're going to work with a pre-tax interest rate. Do not be tempted to go and adjust that for tax. Yeah, apples. Pre-tax, after tax. In this case, our cash flows are all pre-tax. There is no tax. So therefore, we will use the government bond rate of 7% pre-tax. We're going to work pre-tax. Using NPVs, determine which one they should do. Should they get the e-toll? Should they increase the fuel levy? Which one? Okay. The question is only dealing with Western Cape. I don't know if they say where they say that. Oh, wait, I've missed out the whole beginning bit of the question, haven't I? Sorry, here's the story. I missed out the whole story. But it's the same story. After the successful launching of the World Cup, we're going to Western Cape provincial government is hosting the Olympics, so they need to fix the roads. And here's the two alternatives. Gantries at different points on the Western Cape roads. The gantry reads the registration details, passes it on to a control center in Paarl, where the amount owed for passing is established. It's sent to the motor vehicle owner's bank account, instructing the bank account to deduct the money. They have to register. Visitors will also have to register. Alternative 2, no e-tolls, but a special levy added to the fuel price. The levy is then transferred to SANRAL. So this was just the story. Sorry, I should have read this first. The next question is ratios. You'll see that the next question has lots of pages because it's ratios. So they have a P&L and a financial position, etc. But we're going to start with this one. Determine the future value of the USA debentures. This is a forex question, a small forex question. So let's start with that one. Determine the future value of the USA debentures. If we go back, the information is about these debentures is here. I4U balanced fund invested $500,000 in debentures on the 1st of January 2015. Only 90 days are left before the debentures mature. So they're going to mature in 90 days. Mr. Bongani has the following information to determine a 90-day forward rate. He has the spot rate, which is the selling rate. The bank is selling in South Africa. And then he has given us two interest rates, one in South Africa, one in America. And he's also given us two inflation rates, one in South Africa, one in America. Okay, so I just want you to do both forward rates for me. But then I want you to value the debentures using the interest rate. Interest rate is more the rate that is more the way that we use for more short-term forward rates. The more long-term forward rates we use inflation. But so I want you to work out for me the two forward rates. Remember that from last week? So today we have $1 equal to 10 Rand 95 cents or 9459 cents. The South African interest rate is 9.5% per annum. The US interest rate is 3.3% per annum. So in 90 days, I want you to tell me what is the rate. And then the same with inflation. Sorry? Oh, yeah, this one is... I took somebody's book. I don't know who's... Sorry. Sorry. I'm trying to see if they've got question 3. Assume 365 days in the year. So I want you to assume 365 days in the year. I want you to do a forward rate to value the debentures. So for 4 marks, just the forward rates, please. I want you to just this bit on the debentures. And then we'll look at the other 20 odd marks. They ask you to calculate what the value will be of the debentures in 90 days when they mature. So they're going to mature at $500,000. I want to know in 90 days, how much is that going to be in rands? Yes, it's what we did last week. No, remember you're going to start with rands and dollars, then you're going to add interest for 90 days, and then you're going to have a new rands and a new dollars, and you're going to convert it into then what it is to $1. Remember that from last week. You're going to do the same with inflation as well, just to make sure you can do the calcs. So I'm just going to start with 10 Rand 9459. Do you agree? Do you remember that? Yeah, and then you're going to add interest.
Interest, South African is
5% per annum, so you're going to add it for 90 days. Okay, so that was quite easy, right? And then all they did was they asked you to calculate the 500, what the bonds the debentures would be worth.
The second feature, the 11 points, double one.
That one?
No.
This one?
Yeah.
I divided both sides by that to get that into a 1. I divided by that to get a 1. So then if I divided that side by that, I divided this side by the same.
The future rate.
The future rate is 11210081. But if I want it to 1, then I divide that side by that, and it becomes a 1. I divide this by the same thing, and then you get that number.
But you said
Yeah.
it's the same.
I'm going to give it to you before you go. I'll print it. And interest. Yeah, no, you need the Excel. I'll send you the Excel sheet. Okay. So that was 4 marks. I don't know which one they expected you to use, if they expected you to use the interest rate parity or the purchasing power parity. But as a rule, interest rate parity is more for short term. Purchasing power parity is inflation, it's more long term. And this is only 90 days, so I would go more with the short term, I think, and I would say that that's probably going to be the exchange rate in the short term, 111119. Yeah, to 1, and the debentures then will be 555943. But I think in the exam I might just do both. Okay, let's look at what the rest.
I see that as you being confused.
Maybe.
What if they pull it over?
Yeah.
How many marks is this one?
That was 4. Okay, but now there's 21 marks, the next 21. It says, prepare a memorandum. So that's important. Memorandum, there'll be a mark for just putting a heading. Memo to Mr. whatever, and a heading. Yeah, so prepare a memorandum. There needs to be a memorandum format. And advise them if the fund should invest in shares in this Capti Bank, based on the minimum criteria for new investments. So if I just cut a long story short for you, essentially what happens is that you own a fund management company. You're a fund management company. So you look to invest money that shareholders have given you, right? And you've got these debentures which are coming due. These $500,000 US of debentures, and you're looking to invest this money in a new investment. You've identified this new investment. This new investment is a company called Capti Bank, and they've said to you that new investments are only considered if they meet this criteria. So one of the policies of this investment company, Invest for You, is that new investments have to meet these criteria. The first criteria, the PE ratio, price to earnings. I like to work per share, so it's share price, earnings per share, right? Must be more than 4 times. Market to book ratio. Market value of equity, book value of equity. Market to book, yeah, must be more than 1. Dividend payout ratio. What percentage we pay out as a dividend, isn't it? Which is dividends divided by profit after tax. Must be bigger than inflation plus 15%. So we have to go look to see what's inflation. There we were just given inflation, isn't it? What was it? 5 point something, 6 point something, 5.9? Okay, so this has to be 5.9 plus 15, so it has to be 20.9. Yeah, so dividend payout ratio must be bigger than inflation plus 15%. And then a Z-score outcome indicating that the company has a low risk of failure. Z-score is, they've given you the formulas. So if we look at the information they've given you, he's telling you that he's considering this Capti Bank, yeah, and they've given you the information for Capti Bank. They've given you a P&L for Capti Bank. Those of you that work in banks know P&Ls in banks are basically interest income, interest expense, yeah, primarily, and then there's sometimes a bit of other income, transaction type income. And they give you the P&L, they give you a market price per share and a dividend. They also tell you that the interest expense, you know, when we sometimes work on numbers like earnings before interest and tax. This interest up here is sales and cost of sales basically for the bank, isn't it? That's not interest. Interest is just this one down here, this finance cost. So they say to you in the story, yeah, the finance cost is the day-to-day cost of operations there. The interest expense relates to, oh, that's the top one, sorry. The interest expense relates to interest on purchasing of the building. Okay, so that's the true interest. Then they give you a financial position. You can see it's a bank. Most of their assets, they are long loans and advances to clients. And then most of their liabilities are deposits and bonds. Yeah, so people put money in the bank, they take that money and lend it to other people. The difference in the interest, that's how they make their money. There's equity. Book value of equity, 5911. Sorry, I don't know why it does that. Book value of equity, 5911, down here. They also tell you how many shares. Here they are. Oh. It really doesn't like me doing that. Okay, so they give you the book value, they tell you how many shares. And then here they've given you the Z-score formula. So what you're going to have to do is you're going to have to, for that last bit of the required, so if we look at the ratios you're having to do so far, you're having to work out a PE ratio, you're having to work out a market to book ratio, you're having to work out a dividend payout, yeah, 3. Then you're having to do these 5. These 5, working capital divided by total assets, retained earnings divided by total assets, earnings before interest and tax divided by total assets, market value of equity over total liabilities, sales divided by total assets. Yeah, you're taking those and you're going to plug them into the formula and you're going to get a value. The value for Z-score is 0.2. If it's 0.2, I think it's 0.2. 0.2 or above. Let me just double check. I get confused with the Z and the K off the top of my head. No, it's not. Okay, I'll have a look what that is. I'll tell you what that is. Let me tell you now. I've got the book sitting here in front of me. Okay, it's the Z-score, hey? Z-score 311. Now, in South Africa, we usually use the K-score. The K-score is the 0.2, but now here they've asked you to do Z. So Z-score is, it's more, yeah, it's not exactly what I said. So Z-score bigger than 2.99 is good. Less than 1.81 is bad. In between is a question mark. Okay, that's the Z-score workings. When you put the numbers in, 311. But I did in your handout, I gave you the Z-score. I've given you this when I gave you the handout. When you put the numbers in here, that's a percentage. You must put that in as a percentage. So you must put it in as whatever. If you get 20%, you're going to put 20 there, not 0.2. Okay, so put that in as a percentage. And that as well, and that as well, and that as well. And then the last one is times. It's turnover ratio, sales over assets. Yeah? But those are all percentages. So those over there are percentages. You're going to put in the actual percentage up there. Okay, when you do that calc, that final calc. So we had 3. We had PE, market to book, dividend payout. Now I've got 5 more. That's 8. And then I've got to do the Z. That's 9. 9 ratios, 21 marks. Yeah? Let's go. Remember I said to you when we did ratios that we make adjustments. We make adjustments for goodwill and for unusual items. I didn't see any when I was looking here. They've got intangibles, but it's not goodwill, so it could be a license or a trademark or something like that. They don't have any unusual stuff in their P&L. There's nothing in the P&L that looks particularly unusual. There is an impairment charge for loans to clients, but that's normal for a bank, isn't it? We're not impairing PPE. For a bank, that's like your bad debts. Yeah? Banks, I think that's what they spend a lot of their time doing, isn't figuring out how much of my debt's not recoverable, how much must I provide.
Well, that's the next line, because I do impairments of assets.
Yeah, there's also impairments, but this one is impairments on the loans and advances to clients. So there's nothing in here that seems to be like unusual or non-operational that I would adjust for, or exceptional in any way that I would adjust for, isn't it? So I didn't see any adjustments. So it should be a fairly straightforward, eh? 9 ratio.
25 300 we got the total dividend. That's fine. The one that's 3 4. Okay. So we use the
Are you cheating?
share price. Getting quite puzzled, huh? Yes.
We're trying to unconfuse us.
Oh gosh, okay. So let's see. They gave you share price, 52 Rand 50. They gave you profit, number of shares, gives you earnings per share, PE ratio, price over earnings. Earnings.
Yes, but then the price of the earnings is
52 divided by 9.
divided by 8.99.
Yeah.
It doesn't give us that.
You just kill us for 10 minutes.
Doesn't it? What does it give you?
5.834.
Yeah. Price over earnings.
If you were in America, I would sue you.
Ah, you would, eh? You would. Oh, no, now. So 5.84. Then market to book, 1.02.
We got 1.85. No, we use 32 instead of 41.
Book value, 5911. Yeah, well, that was the book value of equity. That was equity on your financial position, 5911.
So we use, I think, the 3250.
Okay, but the equity includes retained earnings. Who does that belong to?
You see, we didn't use that.
Equity is all reserves because that's dividends you haven't paid out.
Equity. We don't look at shares.
All reserves. Dividends you haven't paid out belongs to ordinary. Ah. So 5911, number of shares 115, 51 Rand 40, 1.02.
Hold on. Book
But we would still get we would still get to meet the requirement because it's about 25.
Yeah. You, okay, so that one was fine. Dividend payout, what did you get? Dividend payout was 24%. Okay. Then you haven't done the K. Okay. Carry on. Mm. Yeah.
So we've got market value at 5911.
Book value is the total equity. 5911. Total equity. If you look at your financial position, it actually says equity. And it has a box and it says equity and it gives you a number. There, look. Turn. No, here. Total equity, 5911. Divided by number of shares, 115. Gives you a book value per share of 51 Rand 40. Otherwise, you could take the 52 Rand 50 and times by the number of shares to compare. Okay.
So the market value per share. Okay, to calculate the market book ratio, you take the market value divided by book value. Right? Per share.
Yeah.
So the first one is 5911 divided by 115.
Gives you.
Gives you 51.4. Then the second one, book value, is what they've given us, 52.50. So it's just
So it's 5250 divided by 51.4. 0.04. Market to book. Market 5250, book 5140. Market to book. Were you going the other way? Okay. When I'm doing it in the exam, I'm going to do that times that and get a number, that times that, get a number, and then add the numbers. I don't know. I wouldn't do it. I wouldn't try to do it on my calculator all at once because then it's too many bits and then things go wrong. And okay.
So it's less than 1.8.
Yeah. So let's have a look. Number 1, we were more than 4. It was good. Number 2, it was more than 1. It was good. Number 3 was more than 20% or 21%. It was good. Number 4 was the Z-score. The Z-score should be more than 1.81 if there's any chance of success. So, because less than 1.81 is fail. We've got 0.87. Okay, now, what worries me about this question is that the reason that I think they've got such a poor Z-score is because it's a bank. And the last piece of the Z-score is sales over assets. It's asset turnover. Their sales in relation to assets are tiny. Yeah? 0.29, the asset turnover. In a normal company that has sales, that number is times. It's times. So it's going to be like 3 times, 4 times, isn't it? We're getting 0.3 times. So that, I think, is the number that's making this ratio go skew. So I would say that in the exam that this is a bank, and I'm not sure that an asset turnover ratio is an appropriate ratio for a bank. In fact, it isn't an appropriate ratio for a bank, isn't it? I know that, yeah, when I did auditing, when we had banks, we used to do like 2 audits. We would audit the P&L and we would audit the balance sheet, and we would audit them separate from each other, because in a bank environment, your balance sheet or your statement of financial position is big balances people have deposited, big balances that you've given. But the return on those balances is just your interest, isn't it? It's small. So the P&L in relation to the balance sheet doesn't really bear a good relationship, not like a manufacturing company or a retail company. So this kind of ratio, this sales ratio, and can you see the weighting? Look at the weighting of the sales ratio compared to the other weightings. The sales ratio weights 0.999. The other ones weight 0.012, 0.014, 0.033. Can you see? So not only is this a really rubbish ratio, but according to the Z-score, it's giving it a huge weighting in comparison with the others. Yeah, the Z-score looks very much at how much turnover you can generate from your sales, from your assets. And in a bank, there is no such thing as generating turnover from assets, isn't it? You earn interest. So, I don't know, that's probably the reason for that. But you would just do your memo, you would do your 9 ratios, and you would conclude that if they had to follow strictly, then it meets on all of them except for the Z-score. And you can say it's because of the sales ratio, or you can just leave it at that. It wasn't so bad, huh? No. All right, question 4, the last one. My advice with ratios, there will be ratios in the paper, right? My advice with ratios is practice some before you get there, but then really look at it the day before. Because you need them to be fresh, isn't it? In your mind, you need to know what the ratios are in case they don't give you. Here they were quite nice, like they gave you the formulas, eh? You need to know if they are percentages, if they are times, and what they mean. Yeah, you need to know those things. Right, then question 4 is a mergers question. This was the one we were looking at last time with that Nando's and Barcelos thing, Barcelos group. So what they did is they changed the names around of Nando's and Barcelos, and we have these fast food chicken restaurants that have announced that they're going to merge. So what we're going to have is 2 companies that are going to merge with each other. They've given us, at the bottom here, values that they're going to take over the assets at. And then they also give us information to be able to work out goodwill. So at the bottom here they say goodwill will be calculated based on the following information. So I'll get to that. The purchase price is going to be settled in shares. What did I do now? The purchase price is going to be settled in shares. And the question that they're asking you for in the required is to draft a report to the directors addressing how many shares they must issue to the individual shareholders. Okay, then there's some extra treasury discussion or theory questions at the end. But I just want to take you through a picture of what it looks like, this Nando's Barcelos. So we have, I think it's Bardos, and Narcelos, like that. And they've given you, and they are going to merge into a new company. And this new company is going to get PPE or assets. I think, did they say PPE or did they say assets? What do they say? PPE 40 and 12.75. Okay, so what they're going to take over is 40 million of PPE and 12.75 million of PPE plus goodwill. And that's what's going to land up in this new company. So when I form this new company will have a statement of financial position. It's going to have PPE, goodwill, and then the other side is going to have share capital. And the share capital it's going to have is to the shareholders of B and to the shareholders of N. And they're asking you how many shares are each of those shareholders going to get. Okay. Now, the tricky part of this question, and I don't know, I'm going to leave it up to you to decide if you, I think we must go through it. The tricky part of this question is when you look at the information, you see that the companies at the moment, where's the P&L? It's at the bottom here. You see that the companies have shares in each other. When you look at the company's assets, they each have PPE, then they have investments in each other, and then they have equity. That's all they've got. They've got these investments in each other, right? So this one has 110 million shares in that one, and that one has 125 million shares in the other. So if we look at the percentages, they own 110 of these. What percentage is that? 20%. And Nancelos owns 125 million shares in this one. 125, it's 10%. Okay, so when we look at the shareholders, here's the shareholder. This shareholder, he only owns 90% of B. That's what he owns. Do you agree? Because the other 10% is owned by the other company. And when we look at this shareholder, this shareholder owns 80% of N. So when we're looking at the number of shares that will be issued, we have to work out those values. The other thing is that the value of B is equal to the fair value of B plus 20%. B equals B plus 20% of N. Do you agree? Because that's the value of B. And then the value of N is PPE plus goodwill plus 10% of B. We have this problem with the cross-holding. So we have to do simultaneous equations to be able to work out values. Now, this exact question, this exact sort of similar example, used to be in your study guide. It isn't anywhere in the textbook. It used to be in the study guide, but they've removed it. That's why when I did it, I thought, well, they've removed it. They don't expect you to know how to do these cross-holdings anymore. But now it's here in the exams. I don't know if they expect you to be able to do it. If they don't, yeah. It was in last year's study guide. And then what happened with the study guide is they took certain things out. Remember when we were doing mergers financing, I said to you there's some stuff that's been taken out there as well. This was one that was taken out. Let me take you through it. And then, I don't know, I think it's something we need to just keep an eye on my UNISA, isn't it? Or maybe one of you can send a mail to one of the lecturers and ask about this cross-holding and whether it would be examinable or not. Cross-holdings, yeah. The other thing that's funny here is also, it's a valuation method that we used to teach in the old ACN 308, which we don't teach anymore because it's not in the textbook. It's not in this new textbook that you guys are working with. It's got to do with a way of calculating the value of goodwill using super profits. So it's a bit like residual income. So I'm going to take you through it so we can see what the goodwill would be, and then we're going to practice doing the calc so you can see how it would work. So essentially we've been told that what was the value of their assets? 40, hey? And then that one was 12.75. Okay, so we've been told that we're going to take over those assets at 40, those are 12.75, plus we're going to attribute goodwill to each of the companies. The way that they attribute goodwill, they said, is going to be based on this. So if we look at this, it's a little bit like residual income. It says the anticipated future profit is this, 75851780. A fair rate of return is 15% and 10%. So if we use this information, we can work out something that is like residual income. Do you agree? It's the remaining, it's the excess profit. And then they say to you that the duration of this excess profit is 5 years and 5 years. So you can work out the present value of each of those. And that gives you then the goodwill number. Okay, let me show it to you here. Here's the goodwill calc. Let me just, oops. No, let me copy it from here. Just the goodwill calc so that. Okay, so here's just the goodwill calc. They're going to make income of 7585. The return is 15%. If I take 15% of assets, what do they have as assets? What's the number they've got as assets for B? 39. Okay, work that out for me. No, we're going to work on the 40. Sorry, that's the value of the assets. Okay, so we say the assets are worth 40. Do you agree? 40, they must make a return of 15%, so they must make a return of 6. If they're going to make a return of 7585, this is residual income or super profits. If I have this super profit for 5 years, yeah, and I discount it at the 15%, this is the goodwill number. So plug it into your calcs, you'll see. So 1585 is the payment for 5 years using a discount rate of 15%. So they said to you, goodwill is based on the super profits that will be earned by the company for the next 5 years is what they said they're going to earn there. So for 5 years, the company should make a return of 6 million. They're going to make a return of 7585. So there's going to be extra profit of 1585 for 5 years at 15% discount rate. 5313 is the present value. Do you agree? On the other side, if we work with the other company, they must make 10% on 12.75 million, so they must make 1275. They're currently making 1780, so they have super profits of 505. I'm also going to discount that over 5 years, but I'm going to do it at 10%. I get that goodwill number, 1914. So now the total value of B, 45,313 million. The total value of that one, N, 14,665 million. Do you agree? Okay, so PPE, the market values of PPE were given. They then gave you super profits to work out goodwill. How much extra profit are they making for how long? That's the value of the goodwill. Yeah. And we now have a value of the assets and goodwill of the two companies. But now we've got the cross-holding to deal with. Right? So the cross-holding formulas then say B is equal to 45,313 plus 20% of N. N is equal to 665 plus 10% of B. Do you agree? We start? Not sure. And then you solve simultaneous equations. Okay, so all I'm going to do is I can plug B into this bottom one. N is 14,665 plus 10% of 45,313 times 20% N. This is 100% N. Solve it, simultaneous equations. You should get a value for N. I got 19,587,49231. Let me just check your. But how did you then? What did you plug in for N? Did you plug that value in for N?
No,
N is this and this.
that N.
Yeah.
That N there.
Yeah, that's why you have to say N is, if you want to plug that in there, you have to plug this whole thing in there.
Oh, that's on a little bit.
Yeah.
But only a little bit.
Yeah, it's because it's only 10%. Yeah, so I don't know if this is something that they would ask or not ask. Yes, yes, 100% in. So now multiply this 10% into there and into there. Remember from school days, I don't know what they call it, but you multiply like this, there and there. Yeah. So now, if we're looking at, because now they're asking you what will the shareholders, what shares to give the shareholders, isn't it? Remember we had said then, the shareholder for N, he gets 80% of that number, isn't it? And the shareholder for B gets 90% of that number. So what are the numbers? Just give them to me. Is it that? So now if I do a balance sheet, a little mini balance sheet, I've got PPE, 40 plus 12.75, 52.75. I have goodwill. What was my goodwill numbers? 53131914. What is that? Seven, 227. It gives me a total of 59,977. And that's represented by equity. Do you agree? So this is assets. It's represented by equity. Equity is share capital, N shareholder, and B shareholder. What was the numbers I had? 15,670 and 44,308. There's your balance sheet that balances, right? So all it is it's a merger. We took two companies, we merged into one. We value assets in the one, we value goodwill in the one. We value assets in the other, we value goodwill in the other. That's what comes into my new company. There's the two numbers there. And then that needs to then be represented by equity. It's a brand new company. There's no retained earnings. So I'm just figuring out when the two companies merge in the new company, how many shares must those shareholders get? How many shares must those shareholders get, isn't it? And those shareholders are only getting a piece. Those shareholders are only getting a piece of that company. They're not getting all of it. They're only getting 80% and 90% because the other bits are not held by them, isn't it? So that guy's getting that and that guy's getting this. But then when I do my balance sheet, it must balance because if it doesn't balance, I've made a mistake, isn't it? So I don't think that they will give you cross holdings because, like I said, there's nothing in the textbook about cross holdings, and now there's nothing in your study guide about cross holdings. But it does worry me that this exam paper is still there with this cross holdings question in it, and that they haven't said, ignore that or don't ignore that. But maybe the time is still coming, I don't know. The problem, are you sending? Yeah. The reason that I prefer you guys to send the mail rather than me is because you send it on your MyUnisa, hey. I find when I send mails from not the MyUnisa, they just get ignored or... No, I don't know, you can try. But I think that they tend to respond to the MyUnisa ones, is it? If you email with the... What? Is there an email address? Oh, okay. So as long as you send it there, it doesn't matter where you send it from. Oh, okay. Yeah. Yeah. To do your simultaneous.
Because this is just the maths part.
Yes.
We copied it from you. So we just
Yes.
multiplying the. So 10% of
Yes, it's fine. And that's 2, that's 98, yeah. So this plus this doesn't give you that.
14.66.
And it's 4 point.
No.
Because that's a comma there as well. Otherwise, I mean, that can't be 14 and that whole,
45 point.
45.
Sorry, I mean in millions, eh? Yeah, sorry, it's because all my numbers are in millions.
My bad, guys. But I'm thinking, no way, this thing can't.
Okay, so everything after is set on this one. Is set.
Huh?
He was doing it to the point, and I told him, don't do to that point. 'cause
It's not 45, it's 4.5 there, because it's 10%. 4.5,
So when you come down,
it's 4.5, so then it becomes
Yeah, so we take that
14,665.
point, yeah.
Yeah.
See, I get it whole thing.
Put the dot there, yeah. Okay, now if you add it up, you'll see it will work. Okay, your papers are there in front. I'll see you on the 4th of June, or I'll see you on the 29th of May, depending how you're feeling when the time comes. But I think that my opinion on it is on that day, you're better off spending the day doing past exam papers than spending here listening to me saying the things you've already heard me say. But see how you're feeling when that day comes. Because if you do nothing between now and then, your knowledge is all going to be gone. So then you need time, you need a refresher. I'm hoping, I don't know, I know you guys it's more difficult. My full-time students, I hammer into them. I want them to do a MAC question or a whatever question at least every other day. But I know for you it's almost impossible because now you've got other exams to worry about. Hey? But it does worry me.
Next week are we coming?
No. Now only in June. 4th of June.
When are we meeting for the other math class?
Also same day.
4th of June in the morning. 4th June.
Same time. Yeah. 4th of June is our final revision lecture. 20, because now next week you got FAC exams, right? Am I going to see some of you tomorrow? Only in Dira.